If your mortgage payment feels way too high, there are 3 very easy ways to bring it down. Now, whether you already have a home or whether you're in the process of buying one and you're shopping for it and you're looking for it, these 3 simple ways are going to help you lower your total monthly payment. They don't require any refinances, don't require any major changes, and really, best of all, they're pretty much free. But first, before that, my name's Joel. I'm an executive loan advisor here with More Lending, and my job is to educate and empower you to make the right financial decision, especially when you're purchasing a home. Been doing this for well over 5 years, have helped over 300 families achieve home ownership and, more importantly, financial freedom through homeownership by simply sharing these simple tools, just like this video where you're gonna learn of how to save money here and there to budget for your future. So let's get into it. The first tip that I'm gonna give you is to increase your credit score. Now I know that's probably the most basic tip, but stay with me right now, right? Whether you've had something in the past that has affected your credit score or credit card balance that are affecting you, the simplest way is to do these 3 things. So number 1, pay down some credit card balances. Now, here's the trick. You may have an account that has $30,000 owed on a credit card, right? And if you have that much debt, you probably shouldn't be buying a home, but I'm just giving this for an example. If you have an account that owes 10, 5, whatever that is, that very high balance, but you have other small limit credit cards, let's say $200, right? On that $200 limit of credit card, you might owe 100, 150. That credit card is actually affecting you more than your other credit card because you have it maxed out as to in comparison what it owes, right? That's what we call credit utilization. By lowering your credit utilization amongst all your cards across, you're going to actually impact your score in a really mighty way. Obviously, by doing this, you're helping yourself not pay high interest debts as well. And just to give you a fact, as your credit score goes up, I would say there's little plots here, right? Between 620s to 640, right? From a 640 to a 680, and I'm talking about credit score, the interest rate changes pretty drastically. Now, to give you an idea of that, from a 740 plus, you're gonna get the best credit score. From a 720 to 740, you're gonna get a slightly worse one. From a 680 to a 720, you're probably gonna be around that ballpark of score as well. And then from a 680 down, you're just gonna get some of your worst tier rates. Higher rate equals higher monthly payment. Do not want to have a higher monthly payment just because you couldn't take care of your credit. And on top of that, there are a lot of changes to credit legislation that have happened over the last couple of years. Make sure that you're staying up to date on that. The reason I tell you that is because now medical collections of under certain values can actually be removed off your credit instantaneously, and this may actually be affecting you. Other things such as collections charge-offs and other different factors may be holding you back, so you can have a credit specialist or a mortgage specialist like myself take a look at it. Soft pulls are completely free, and we can help you navigate what can and can't be removed off your credit in order to help you qualify for a much better payment. So make sure that you're taking advantage of that. Tip number 2, shop your homeowner's insurance policy. I cannot begin to tell you how important this is, right? You as a homeowner or potential homeowner, right? Whether you own a home or whether you're gonna get a home, you have the ability to shop your homeowner insurance at any time that you'd like. You're not beholden to one, right? In my case, I work with plenty of different insurance brokers or homeowners insurance brokers, and I give multiple numbers out. I give 1, 2, 3, maybe 4 numbers out to insurance brokers, and I always get quotes. I always am looking for the best possible quote for my client that gives them the coverage that they need and an affordable premium. But you'd be surprised at how many insurance carriers there are out there that are giving quotes on homes. And give you the perfect example. I've gotten quotes where I'm getting quoted $7,000 from one broker and $4,000 from another. That's $3,000. That's over $250 of monthly savings that I'm getting. You should be doing this at all times. Not to mention, you should be doing this with your car loans, with your phones, with any type of insurance that you have. You should be shopping it because the rates are always changing, and that is always going to give you some leverage to lower your payment over time. And they always have some really great intro bonuses that you can take hold of. Make sure you're not overpaying on insurance. Make sure you're shopping it. That's very important. And my last tip to lower your total mortgage payment, if you're worried about it, is identifying the right loan type and getting the seller to cover a certain amount of cost. When I say identify the right loan type, first-time home buyers have plenty of different programs. A lot of people are familiar with what we call the FHA loan program. Now, here's the thing. FHA loan program, while it is an amazing loan program, comes with some back-end costs as well. Now, the FHA loan program seems more enticing because it does come in with a lower rate, but here's some things that they don't tell you up front. It does have an added insurance premium on it, right? It has a forever mortgage insurance premium that you're paying on a monthly basis that never comes off. And on top of that, you may find yourself that you have to put an extra 0.5 percentage point down. Now, first-time home buyer, if they're going regular conventional here, they don't have additional costs added to the loan. The PMI does fall off after they've reached 20% equity, and they only have to put 3% down. The difference between these two is that one, if you have a really good credit score, your conventional is probably going to be the route for you to go. If you have a lower credit score, it's probably going to be FHA. So getting a really good breakdown or scenario between which loan is going to be best for you is going to save you so much money down the road. The reason I say that is if you decide to go with an FHA loan for a lower rate and rates drop, then you're going to have to end up refinancing in the future anyways. Now, that refinance can cost you about 2% of your loan amount. So if you think about it, you're going to probably end up paying more money and you finance more money. So over the long term, you are going to end up paying more. For a conventional loan, if you have a worse FICO score, you're probably going to get a higher interest rate, causing your monthly payment to go up. So an FHA loan will probably be the better route for you, especially as you're working your credit score up. It's very crucial for you to know. And on top of that, there's all other types of loans. You can check out my page because I have videos that go across all different types of loan programs that may be beneficial for you in your scenario. And by becoming educated, getting the right programs, getting the right loan to fit your needs is going to save you so much money down the line. And if you're shopping for a home right now, make sure that you're getting the right program, but don't make sure that you're missing out on seller concessions. Yes, seller credits are going to be a huge help. They can help you buy down your interest rate. They can help you cover closing costs. This is basically when the seller gives you money as the buyer to help offset any costs associated with closing costs, rate buy downs, or anything like that. I'm going to make a whole video just on that, so stay tuned for that. But this is really 3 simple ways to lower your monthly mortgage payment without having to refinance and before you purchase. So it's get your credit score into a better position, shop your homeowner's insurance, and make sure you're choosing the right loan program and taking advantage of seller credits in this market, okay? Like I said, guys, if you like this content, subscribe below. Give me a like and give me a follow. It would be a huge help. All I want to do is educate and empower you to make the right financial decisions when you're buying a home, and make sure, because remember, a home is a 30-year mortgage. Trump might make it a 50-year mortgage. I don't agree with different conversation for a different day, but it's a 30-year commitment that you're going to make. Make sure that you're making the right choices beforehand and that you're being educated on this. All right. See you next time. Thank you so much for watching.